Hey there, awesome accounting student. Mark Franke here. This video is from chapter 6, where we're going to talk about how to do a bank reconciliation. I'm going to use problem 6-5 in your book. It's on page 265. 265. So let's talk for a second about what we're trying to do with a bank reconciliation. How does this work? We have a general ledger where we have a cash account. We have a bank account with some bank, whatever it is, Wells Fargo, B of A, Chase, whatever. They keep track of everything that comes to the bank. They don't know what checks you've written. They only know what checks have cleared or come and been presented for payment. So they're sending a statement based on the things that they know have happened. We also have the general ledger, which has a list of things, deposits that we've made and payments that we've made. So cash in, cash out. So when we reconcile, we're looking for things that are on the bank statement that are not in the general ledger, and we're looking for things that are on the general ledger that are not on the bank statement. That is the process of reconciling any two pieces of information in the accounting world, right? A reconciliation means I've got this document and I've got this document. They should theoretically be the same, but they're not. And we need to find out why they're not. So things on here that aren't on here and things that are here and not there. So with a bank reconciliation, and the reason this is such an important control for business is because the bank is independent. They're a third party. What are the objectives for the bank to try and misstate stuff? They don't. Banks don't do that, right? The whole purpose of a bank is to provide accurate information to their customers, and they're not going to be in business long if they are creating fraud or causing errors or whatever. Personally, I am not a fan of Bank of America because I've done business with them for many years, and most of the time when I have problems with a bank, it's B of A that's involved. So that's just my personal opinion about B of A. But anyway, the point is banks are generally not in business to create errors. Here's my feeling about B of A. B of A is like the McDonald's of the banking world. There's nothing wrong with McDonald's. It's consistent, but it's not the best burger, and it's not, there's a lot of them around, and they're consistently the same. That's Bank of America. Okay, so let's take a look at the bank reconciliation for problem 6.5b. This is Shamara Systems and a bank reconciliation. And this is for the month ended May. Actually, what we should really do is just put May 31. And we'll use 2019. Because we're talking about the bank account and the cash account, there is, this is a balance sheet account, and so we want it as a specific date. We're reconciling this bank statement as of May 31st on 2019. So we go to the bank statement, we get the amount from the bank statement to $21,762.70. And we look in the general ledger, and the balance in the general ledger is $15,177.30. They're not the same. Why are they not the same? Because we have timing things that happen. And so we have things that are on the bank statement that we haven't recorded in the general ledger yet, and we have things that are on the general ledger that the bank doesn't know about yet. So the first thing that we are going to identify are deposits in transit. So if we literally take what they've given us the general ledger at the bottom of the page, and this is on page 265. They've given us the general ledger, and they've given us the bank statement. So we look at the bank statement, and we start checking everything off the bank statement on both sides. So if it's on both sides, in other words, if it's on the bank statement and it's on the general ledger, we're not worried about it. So that's why we just check them off and forget about them. The things that are left, things we couldn't check off between the bank statement and the general ledger, are what we're looking for. And either they're on the bank statement and not on the general ledger, or they're on the general ledger and not on the bank statement. So one thing we know that's on the general ledger that's not on the bank statement is a deposit in transit. This is the last deposit that was made on May 31st for $2,727.30. It didn't go to the bank yet. It will, but not in May. It will be in the first week in June. Okay, so we now are adding that as if it had deposited to the bank statement. There's also 3 checks that are outstanding: $1,780, $1,786, and $1,789. If you compare what's on the bank statement with what's on the general ledger, you'll notice that these 3 checks did not clear the bank yet. They will, but they just haven't yet. So when we add all that up, including the beginning balance, our adjusted bank balance is $22,071.50. $22,071.50. So now we have to deal with the things that were on the bank statement and not on the general ledger. And there's actually 4 things here. We've got they collected a note. So I'm going to say add collection of note receivable. That amount is $73.50. Does this happen? Yes. Sometimes customers may just send in money to our bank account, particularly internationally. I do a lot of work with companies in the airline business, and they have customers all over the world, airlines, that will just wire transfer directly into our bank account. Most of the time they're going to tell us, but sometimes they don't. And so this money just shows up, and so it hasn't been recorded in the general ledger yet because we didn't know about it until we got the bank statement. Then we have an error. When you check off the things in the bank statement versus the general ledger, you'll notice that check 1788 has an error. It's a $10 error. We need to fix it. We also had a customer who bounced a check. W Sox. In other words, they gave us a check, we put it in the bank account, and then maybe a week or 2 later, their bank came back and said, sorry, but this person doesn't have enough money in their account, so now the bank has taken it out of our account, and we need to put it back in the general ledger. And most importantly, we need to go back to the customer, Mr. or Ms. Sox, and say, hey, your check bounced, and unless I get paid right away, I'm going to charge you triple the amount that you owed me, which is, the law says you can do that. If somebody bounces a check, you can literally sue them for triple the amount of the check. Then we have a service charge for $14. So when I add all that up, hopefully I will get the same balance, $22,071.50, $22,071.50. Yeehaw, we got the right balance. So now what we have to do is we got to make journal entries. And so I've got a little journal set up here. that is for that purpose. Do we need to make journal entries for the stuff on the bank side, the top? No. Why? They've already been recorded in the general ledger. We don't need to record them again. The stuff we need to worry about is down below, the stuff that is adjustments to the general ledger. So this is the general journal. We're going to make these adjustments at the end of May. So these will all be dated May 31, 2019. The first one is a debit to cash, $73.50, and a credit to notes receivable. Notes receivable is going down, cash is going up. Debit cash, and this is to record the note collected. If we had who the person was that owed us the money, we could have put that in the journal, but we don't have that, so we'll just be generic about it. Then we've got the error on check 1788. This is also, all of these adjustments are going to be as of the end of the month. We're going to debit utilities expense because the check was written for $10 more than it was recorded in the general ledger. So cash is going down. This is to correct error on check 1788. Our NSF check from WSOX, we're putting it back into accounts receivable. Debit accounts receivable, $431.80, and credit cash. Cash is going down, that's credit to cash. Accounts receivable is going up, and this is to record NSF check from WSOX. And again, we've got to go back to that customer and say, hey, we need our dough. And then the last one is the service charge. We're going to debit, I like bank charge expense. I think the book probably tells you to put it into miscellaneous expense. That's fine too. I just don't personally like miscellaneous expense because it doesn't mean anything, and I don't like things that don't mean anything. So bank charge expense is the debit. We're going to credit cash. Cash is going down, and this is to record service charge for May or something like that. So there's our journal entries. Those need to be posted to the general ledger, and when they are, the balance in the general ledger is going to be $22,071.50. And then we have our reconciling items that will ultimately clear the bank, and everything will be cool. That's how to prepare a bank reconciliation. Thanks for listening. This is really, really, really important stuff. In fact, I'll tell you, I started my accounting practice years ago, I had no clients. I started by going out and doing bank reconciliations because there's so many companies that don't want to do it, and it's really important to do it. And I would find thousands and thousands of dollars of errors in the general ledger of these companies that I would just tell them, look, I'll just come out and I'll reconcile your bank account for you, and if you don't want to pay me, you don't have to pay me. It's how I got many, many, many of my clients initially, because I would go reconcile their bank account and they would see that they had errors in their accounting system that I could help them fix. So anyway, thanks for listening. I'll see you again next time. Bye-bye.